Welcome to the Business Insider series from the Trulaske College of Business. My name is Balaji Rajagopalan, and it is my honor to serve as the Dean. I'm delighted to introduce two of our finest faculty who will be talking about misinformation and the macroeconomy. Dr. Matt Glendening, Associate Professor and Anderson alumni, and Joe Silvoso Distinguished Professor will be presenting this afternoon, along with Dr. Ken Shaw, who holds the KPMG and Joe Silvoso Distinguished Professorship. Dr. Matt Glendening graduated with his doctorate from the University of Iowa and teaches intermediate financial accounting and data analytics. Professor Glendening's research focuses on financial reporting and corporate governance, and his work has been published in top-tier journals like the Accounting Review, the Review of Accounting Studies, the Journal of International Business Studies, and many more. Dr. Ken Shaw received his PhD from the University of Wisconsin, and he teaches financial accounting and corporate governance. Dr. Shaw won the Trulaske College of Business Distinguished Research Achievement Award recently in 2023. He is also the recipient of numerous teaching awards, including the Trulaske College of Business O'Brien Teaching Excellence Award in 2011, the School of Accountancy Advisory Board Teaching Excellence Award in 2018, the Williams Keepers LLC Teaching Excellence Award in 2007, and the Best First Year Professor Award from the 2019 and 2016 Executive MBA graduating class. It is my honor to have two of our finest faculty present on the topic of misinformation and macroeconomy. They will be talking about the question of, does the absence of reliable aggregate accounting information harm society? I will now turn the podium over to Dr. Ken Shaw.
Thank you, Dean Rajagopalan, for that very kind introduction. I'm delighted to be here to talk about this topic, misinformation and the macroeconomy. Very happy to do so with my colleague here at the Trulaske College of Business, Matt Glendening. If you have questions, we're going to try to utilize the Q&A function, and feel free to input questions there, and we'll try to take some at the end of the presentation. This presentation is building off a paper that Matt and I recently had published in the Accounting Review, along with fellow co-authors Danielle Beniche and David Farber, Aggregate Financial Misreporting and the Predictability of U.S. Recessions and GDP Growth. This is one of our finest academic journals, so we are delighted to be able to publish this work in there, and also very happy that this work has received some notoriety. Some of you may have come across some of this in financial press, Wall Street Journal, Forbes, etc., talking about an accounting fraud indicator, a little-known accounting measure. So part of what we want to do today is educate the audience on our measure and its usefulness for predicting the future state of the economy. A little bit of an overview. This is a format that we'll try to follow. We're going to start off with discussing some historical background, prior research on recession and GDP prediction. From there, we're going to build a theoretical role for our idea of misinformation being important in that prediction mode. Then we're going to talk about the measure itself, first starting with a firm level measure of misinformation, and then how we aggregate that up into an economy-wide measure and use that to predict economy outcomes. We'll talk about our results, summarize our key results, and we'll make a prediction for 2024. So there's been a long history of research trying to uncover leading indicators of recession and or GDP growth. We certainly won't cover all of those papers today, but we want to build a role for the prior work and how we fit in. So a very important seminal paper by Estrella in Michigan in 1998. They examined a lot of variables, a long list of economic variables, interest rates spreads, stock prices, consumer price index, consumer sentiment, monetary aggregates, M1, M2, other indicators from other papers. So quite an extensive list. You notice I didn't say anything about accounting in there. So they had no accounting in their paper. They're economists. We're going to build in accounting later. But this is a very important paper, and it has some key conclusions for us. The first key conclusion that they draw is that if we want to study economic prediction, we need to do what's called out-of-sample testing, which they do and which we do. So the basic idea being we estimate some relations between independent and dependent variables within a certain sample period, and we take the coefficients or what we've learned from that original sample period and then try it in a holdout sample period or a subsequent sample period out of sample. How well does these variables predict out of sample? And a very important takeaway from Estrella in Michigan is that a model might look pretty good in sample prediction, but it really has no usefulness in out of sample prediction. So they really strongly make the case to do out of sample prediction, which is certainly one of the things that we do. With respect to their findings, their first important finding, I would say, is that stock prices are a pretty good predictor of future recession. In particular, looking ahead 1 quarter, 2 quarters, 3 quarters, stock prices are, of course, are a forward-looking measure, and that forward look is good at predicting recession. Their next key result is that the other, and in fact, the dominant variable is the yield curve spread, the difference between the interest rate on long-term Treasury bonds and short-term Treasury bills. And in fact, what they find is that yield curve spread is a dominant measure. When you add stock prices to a model with yield curve spread, stock prices is incrementally helpful in predicting future recession. Then they go on further and they ask, well, what if we add other variables on top of these two? And they really don't find any usefulness of other variables in predicting recession. Now that's important. That's an important starting point for our paper, because we're going to start with focusing on out of sample prediction in a parsimonious model with yield curve spread and stock prices as our key additional variables. And ultimately, we want to ask, does our measure add anything beyond these two variables? We'll talk later, of course, we're going to do many, many different models with additional variables, in part because subsequent research has found in other settings, and not necessarily in predicting recession or GDP growth, but predicting other economic indicators, some of these variables have been important. Market volatility, risk-free rate, market sentiment, etc. And you notice from this short list, there's really only one accounting measure on there, aggregate earnings growth. And as co-authors, we found this quite intriguing. Many of us are familiar with a bias that some people have, is that accounting is all backwards looking. It reports on the past, has nothing to do with the future. Those of us that do research know otherwise. Yes, we are accountants. We prepare earnings with a backward look, let's say the quarter that passed or the year that just passed. But there's quite a lot of research that shows that information is useful in predicting the future. And most on point for our paper, if you aggregate up earnings growth across a sample of firms, that was proven to be useful for predicting GDP growth. That's a very intriguing finding, and it really is important takeoff for us, because then we want to build from that as accountants. We know that accounting earnings are sometimes misstated. For example, aggressive reporting. We are all unfortunately familiar with it. So then we want to ask, is there a role for misinformation, in particular aggregate misinformation, in this prediction?
Thanks for leading us off, Ken. I want to reiterate that it's a pleasure to be here today to share our research with you. And I'm going to pick things up with our research question. So our our central research question is, can an ex-ante measure of the aggregate level of financial misreporting predict U.S. recessions and GDP growth? The premise for this research question is that publicly traded firms in the U.S. are required to report quarterly performance reports. And this is intended to facilitate decision-making in the economy. But the issue is that when financial reporting is not adequately monitored, companies can manipulate financial information. And as a result, users, which would include peer firms, will make suboptimal decisions because they rely on this information. And these suboptimal decisions can have damaging consequences. In terms of linking aggregate misreporting to future macroeconomic activity, we begin with this idea that there is lax monitoring during good times. And this is because good news is just not overly scrutinized during good times. There's this sense to sort of keep the good times rolling. And as a result, some firms will misreport good news because there's incentives to report positive results and because there is lax monitoring. In turn, peer firms will rely on this information and make suboptimal spending decisions because they're basing these decisions on overly optimistic reports being issued by these misreporting firms. But eventually, monitoring will kick in and misreporting will subside. And this could happen because there are initial signs of economic headwinds. Maybe some firms begin to report poor earnings news. Maybe a misreporting firm gets caught. They could issue a restatement, or they could be subject to an SEC investigation. Either way, peer firms will realize that the information that they were relying on was too optimistic and will curtail spending on investment, production, and employment. And this negative effect of firm economic activity will also have adverse consequences for consumer spending as well. So this provides the linkage between aggregate misreporting and future macroeconomic activity. We believe this research question is important for several reasons. So first, economists have studied recession prediction and GDP prediction for decades. It's notoriously difficult to predict an economic downturn. So we believe that our results have the potential to improve these prediction models. Second, we think our results should be of interest to capital market participants and to policymakers. So understanding the current economic state and the future economic state is important to investors' asset allocation decisions. It's important to firm managers' decisions when it comes to saving versus spending. And it's also important to macroeconomic policy decisions. And then lastly, in terms of the accounting literature, there's been a lot of work on the consequences of misreporting at the firm level in terms of its costs, but no prior study has created an aggregate measure of misreporting and studied its consequences at the macroeconomic level. And so we believe our results are pushing that literature forward. Academic researchers have two broad approaches when trying to measure misreporting. The first is what I would call an ex post approach. And this would utilize actual cases of misreporting, such as a restatement or an SEC investigation. So an SEC investigation would be identified through what we call an accounting, auditing, and enforcement release. It's commonly abbreviated AAER. The problem with this approach in our setting is that not all cases of misreporting are caught, and this is especially so for less severe cases. In addition, there can be a multi-year delay between the misreporting period and the actual revelation of misreporting. And so this prevents any sort of real-time analysis of misreporting risk, which is really what we need to facilitate our macroeconomic predictions. What we use is called an ex-ante approach, which would use a measure of the likelihood of misreporting using a model that incorporates known predictors of prior cases of misreporting. And so how this approach is implemented is that a researcher would estimate a regression where the outcome variable is fraud, and that's a binary variable equal to 1 if the company committed fraud in a given year, 0 otherwise. And then the explanatory variables in this model will be a list of variables that capture distortions in financial statements, along with incentives and the ability to commit accounting fraud. And then this regression is estimated and it produces a set of estimated coefficients. And then rolling forward, one can use the predicted values from this model to essentially score the risk of fraud for any given firm year, even if fraud equals 0 for that observation. So the nice thing about this approach is that it produces a continuum of fraud risk. And a high score does not necessarily mean that this firm is a fraudulent firm. It just means that the underlying characteristics of this firm are pointing in the direction of higher fraud risk. So there have been two primary models that have been developed using this approach. The first is called M-score, and that stands for manipulation score. And this was developed by Daniel Benish in a paper in 1999, and he's actually a co-author on this study. The other one is called F-score. It stands for fraud score, and this was developed by DeChao et al. In a paper published in 2011. Research suggests that both of these measures are economically viable for investors to identify misreporting risk. There is some overlap in the models in terms of the concepts underlying the variables included, but there are some different variables included in these two models. Our discussion today is going to focus on the M-score because that's the primary measure we use in our study. So the next two slides are going to walk us through the 8 predictors included in the M-score. And so the M-score is a screening model that screens on the risk of earnings manipulation. And the first 4 variables are included on this slide, and then the next slide will be variables 5 through 8. The first variable is called DSR, and it stands for Days Sales Receivable Index. And this is intended to capture distortions in receivables that can result from inflated revenue. And this is measured as the current receivables to sales ratio divided by the prior year receivables to sales ratio. And as this index increases, it identifies cases where there are abnormally higher credit sales in the current year relative to the prior year. The next one is GMI, and this stands for Gross Margin Index. This captures declining gross margins that can incentivize companies to manipulate earnings. And this is measured as the prior year gross margin percentage scaled by the current year gross margin percentage. And as this index increases, it indicates instances where there are deteriorating gross margins, thereby providing that incentive. The next is AQI, which stands for Asset Quality Index. And this captures inconsistencies in non-current assets other than PP&E. So those sort of softer type assets that could result from unwarranted expenditure capitalization rather than expensing. So this is measured as the current year soft asset percentage divided by the prior year soft asset percentage. And as this index increases, it indicates there's growth in those softer types of assets that could be aggressively capitalized. The fourth is SGI, that stands for Sales Growth Index, and this captures the incentive to manage growth perceptions, which can lead companies to manipulate both sales and earnings. So this is measured as current year sales scaled by prior year sales. And as this index increases, it indicates that there is increasing pressure to meet growth expectations. So that's the first 4. On this slide are variables 5 through 8. The next one is DEPI, stands for Depreciation Index. And this captures declining depreciation rates as a form of earnings manipulation. And this is measured at the prior year depreciation percent as a percent of fixed assets scaled by the current year depreciation expense as a percent of fixed assets. And as this index increases, that denominator is decreasing, which indicates decreasing depreciation rates. The next is SGAI, stands for Sales, General, and Administrative Expenses Index. This captures administrative and marketing inefficiencies that would result from larger fixed SG&A expenses, which can lead companies to manipulate earnings. This is measured as the current year scaled SG&A expense relative to the prior year scaled SG&A expense. And as this index increases, it indicates that there's an increasing SG&A expense margin. And that is a negative signal of the firm's prospects, which would provide this incentive to manage earnings. The seventh is accruals, and this is the one variable that is not an index variable. So I've been using this term index, and those variables are variables measured as the current year value relative to prior year value. Accruals is not one of those. So accruals captures instances where accounting earnings is not supported by underlying cash flows. And this is measured as the accrual portion of return on assets. And as this value increases, it indicates that there's more income increasing accruals. The last one here is LEV, stands for leverage index. And this captures debt constraint incentives to manipulate earnings. And this is measured as the current year debt to asset ratio divided by the prior year debt to asset ratio. And as this index increases, it indicates that there are increasing debt pressures to manage earnings. So that provides a breakdown of the 8 variables included in this Beneish M-score model. And then on the next slide, we'll actually go through the model.
Yeah, so with those variables, and many of you would probably recognize some of those and can think of anecdotal evidence of prior frauds with them. For example, depreciation, pretty well known, waste management, extended useful lives of assets and reduced depreciation expense, sales growth. Frequently in misreporting, sales growth is involved, or sales are overstated. Accounts receivable, a classic example, Friedman's Jewelers. So part of the beauty of Danielle Benish's original paper here is combining those, what we might call anecdotes, into variables, as Matt discussed on the prior page, and put those to some rigorous statistical testing to develop a model. And his original paper had data from 1982 to 1992, 74 earnings manipulators identified by SEC AER and or by news media, and over 2,300 control firms that were matched, that looked like the earnings manipulators on key dimensions like sales growth and industry. And then using a statistical estimation model to differentiate or identify those fraud firms versus the control non-fraud firms. So dependent variable is fraud, 1 or 0, 1 yes, 0 no. The independent variables previously discussed. Put that into a statistical package, and then out from that comes estimated coefficients. We call them regression coefficients. And this M-score equation that we have highlighted here, that is the way then to compute M-score. And this is in part is what we mean by ex ante, or probability, looking ahead. We can take this equation developed in that paper using data that ended in 1992. We can take these coefficients and apply them to current data. For example, we could go to end of year 2023, take this equation and estimate M-score for a particular firm of interest. Start with the intercept. So this is a regression model trying to fit a line of best fit between a bunch of points. There's an intercept. This minus 4.84 is that intercept. And then start there and add to that with your firm's data, let's say end of year 2023, add to that the days sales index times 0.92, add to that gross margin index times 0.528, and so on, all the way across this equation. And then combining all of those, out comes an M-score. And that score then is converted into a probability. So we show a distribution there. And the chosen value we have there, minus 1.78, that comes out of Danielle's original paper. So he tried various cutoffs, and part of the issue there is dealing with, we want to identify with a high accuracy as we can, the true positives, the real fraud firms, without also identifying a bunch of false positives, sending inaccurate warning signals. So Danielle experimented with various cutoffs, and in his paper, minus 1.78 for this M-score seemed to be a reasonable cutoff to balance this issue of false positives and true positives. So if we overlay that minus 1.78 into this normal distribution, then we get a probability of fraud of 3.76. And the way then that we interpret the M-score is if we move to the right in this distribution, or if we think of a simple number line moving to the right towards zero, higher levels of M-score indicates higher probability of fraud. Now, we talked about the idea of out-of-sample evidence, and one way to think of how out-of-sample evidence comes to play in our paper is these coefficients were developed with data that ended in 1992. We're going to apply those data into a more current time period for a lot of our paper. And so that's one way to think of out-of-sample. We'll talk about others. Benish and other co-authors did some work with his original coefficients to future sample periods, this idea of out of sample. And what these authors wanted to know was how well does the M-score predict what we'll call high profile fraud cases, which unfortunately probably all of us are familiar with around the dot-com era, Enrons and Global Crossing, really quite egregious examples of financial misreporting. How well does the model predict? And it seems to predict about as it did in Danielle's original paper. Identified 12 of the 17 really known egregious high-profile fraud cases. Got 12 of them right, about 71%. Identified some that we would really hope that it would identify. Enron, Global Crossing, Waste Management. These are absolutely outrageous examples, but missed some equally outrageous examples, Health South and Tyco. And that underlies all that's going on here. These things are hard to predict. Fraud is hard to predict. GDP is hard to predict. Recession. This is a tough setting that we're working in. Also in this paper, these authors looked at how well M-score can predict future stock returns. And it seems to predict pretty well. So we can think of what they do there is they'll form portfolio where they want to, a synthetic portfolio where they want to sell groups of firms with high M scores, firms that are more likely than others to be fraud firms. Those are the firms we don't want to hold or buy. We want to sell fraud firms and buy low M score that is less likely to be a probable fraud firm. And what they show essentially is that zero risk hedge portfolio is able to predict future abnormal returns looking ahead 1 year. So we would call this a nice body of evidence for the Benish M score in terms of out of sample, and gives us some comfort with what we're going to do in our paper, which is going further and getting into GDP and recession prediction.
So moving on with the research design in our study, it has several components. The first of which is our firm quarter measure of accounting fraud risk. And here we use the M-score, and we've already talked about that at length. The one difference I'm going to note here is that the M-score, as originally put forth, is a firm year measure, and we deploy it as a firm quarter measure so that we can match the frequency of the macro variables, recession and GDP growth, that we are trying to predict. From here, we create a value-weighted average M-score for all large publicly traded firms in the U.S. each quarter, and we evaluate by beginning market cap. And we do this from Q4 1976 through Q4 2019. So we're working with about 40 years of data. And after we aggregate this up to the calendar quarter level, what we do is we construct a 4-quarter moving average to smooth it out and to accommodate for any seasonality in this measure. From here, we examine whether aggregate M-score is associated with future recession incidents and real GDP growth up to 8 quarters ahead. To do this, the first thing we do is we conduct an in-sample regression analysis, and we use 3 different benchmark models. The first has 2 controls, and I would call this our main model. This model is considered the best by prior research, both in terms of its ability to predict future recession and because it's parsimonious. This includes controls for the interest rate spread and market returns. Spread is the difference between the long-term treasury rate and the short-term treasury rate. So in our setting, we're using the 10-year and 3-month. And the idea here is that investors seek safety in long-term treasuries in the lead up to bad times, which pushes that long-term rate lower. The long-term rate actually tends to invert or go below the short-term rate in the lead up to a recession. And that's why a yield curve inversion is probably the best predictor we have of future recession. With market returns, the idea is that equity markets foresee lower future cash flows for firms and put downward pressure on equity prices in the lead up to a recession. So from here, we add controls and go up to a 5-control model. We have controls for market return volatility, the risk-free rate, the default yield spread, and we go up to model 3, which is a 9-control model. We include controls for investor sentiment, aggregate earnings growth, real GDP growth in the current quarter, and a measure of lagged M-score to account for any serial correlation in our measure. We also examine out-of-sample forecasts, and we do this to remove any look-ahead bias and to try to mimic what a professional forecaster might do in a live setting. So to do this, for example, let's say we're in 1999 Q4, and we're going to call that quarter Q. And we want to use the 6-quarter ahead model, that's the K=6 model, to forecast recession probability for 2001 Q2. So that's 6 quarters ahead. We're calling that a quarter Q plus K. What we would do is we would estimate our model using data from 1976 Q4, the first quarter in our sample, through 1999 Q4. So that's 93 quarters of data. And specifically, we're using data on our independent variables from 1976 Q4 through 1998 Q2. So that's through quarter Q minus K. And data on our dependent variables from 78 Q2 through 99 Q4. So that's through quarter Q. There's a 6-quarter difference with the independent and dependent variables because we're predicting 6 quarters ahead. So what this means is that for an out-of-sample forecast for recession in 2001 Q2, using a 6-quarter ahead horizon, we're not using any data past 1999 Q4. So from here, we estimate this model. This provides estimated coefficients, and we apply those coefficients to independent variables measured at 1999 Q4, so quarter Q. And this provides an estimated probability of recession for 2001 Q2, and that's our Q plus K forecast. And then we compare that to what actually happened. And we do this recursively. So we repeat this for 1 quarter at a time, expanding our sample 1 quarter at a time. So that provides an overview of how we implement our out-of-sample forecast. And before we get into the statistical results, on the next slide is going to provide some visual results.
These are some figures right out of our paper, and we have time series of M-score, spread, and market returns, figures 1, 2, and 3 from our paper. The gray bars here indicate recessionary periods as defined by the National Bureau of Economic Research. And in the top figure, figure 1, that's M-score. That's our aggregate measure. That's where we are making our contribution. The vertical axis, the numbers are getting higher. They're negative numbers. They're getting higher. They're approaching towards 0. So higher values in figure 1 are going to indicate higher aggregate level of misreporting, higher aggregate level of misinformation in the context of what we're talking about here. And we can certainly see in several of the, certainly in the first 5, pretty good close in time peaks in M-score to these gray bars, to the start of these recessionary periods, that is peaking before. The last gray bar, that's the COVID time period, really totally unpredictable. We also see, as is consistent in this area of prediction, some false positive. We see some relatively high aggregate M-scores not accompanied by a gray bar, a recessionary period in this graph. By no means are any of these indicators going to be perfect. It's very complex prediction setting. In figure 2, we're talking then about the interest rate spread, and we have the difference between the long term and the short term. And as that is getting higher, the spread is getting higher. The action in this figure 2 is in the lower part. And in fact, as Matt indicated, this idea of inversion, the short term higher than the long term. And that's coming out of Campbell Harvey's dissertation paper, which even preceded the Estrella and Mishkin paper. And we can see then low levels of this spread measure in figure 2 preceding these recessionary periods, and seems to be doing a pretty good job there as well, this yield curve inversion. The third figure is market returns. Market returns, of course, are quite volatile, so this line bounces up and down. But the idea here is low returns are going to perhaps be an indicator of future economic difficulty. And I would argue we see evidence of that as well. It's imperfect, but we do see preceding these gray bars, recessionary periods, relatively low market returns. So we find this visually appealing. We like this evidence. We have the two key variables from prior research, the spread and the market return. These figures visually those variables are doing what they are supposed to do in our sample, and consistent with prior research. We have figure 1, which is our variable, and it seems to be portraying the picture that we theorize, that we hope for. So the visual is appealing. We need to go further, of course, and we need to take that into actual econometric estimation. And that's what we're showing here with the recession. There's no way that we can show all of our results. There's so many of them and so many permutations of the model. So we're using this as a representative example of our results. And this is from table 3 from our paper. We're showing in sample here, but of course we did this with out of sample, and I'll speak to that. But we have our 3 variables of interest: M-score, spread, and market return. And we have estimated coefficients in the top row of this table for each for each variable. And then the column headings are months, 1 month ahead, 2 month ahead, etc., all the way to k = 8 months ahead. So many, many models estimated here across different months. Then the number in parentheses below that first, the coefficient for each variable, those are t-statistics. So we'll use those and overlay them against statistical distribution to determine statistical significance. So we'll indicate statistical significance in this table with asterisks. So the idea being, if we see 2 asterisks, that's the 0.05 level, pretty strong evidence. 3 asterisks, 0.01 level, strong statistical evidence that you have found something different from 0, different from something that's random or not meaningful. So most important for us, the M-score rows have significant coefficients in k = 5 through k = 8 in each of those. In other words, looking ahead 5 quarters, 6 quarters, etc. M-score is showing an ability to predict future recession. That's statistical significance. We'll talk about economic significance shortly. Important, of course, that we include these prior variables, spread and market returns, and you can clearly see why it's important, because spread is significant in 7 of the 8 quarters. That's consistent with all of this prior research and Harvey's dissertation about the importance of spread and particularly inversion being a very important indicator. It's significant consistently throughout there. Market return, as the Estrella and Mishkin paper pointed out, was a very good indicator short term, 1 quarter ahead, 2 quarters, 3 quarters. That's exactly what we're showing. So this table gives us a lot of comfort, because we have not only controlled for the key variables from prior research, and we have replicated their results, But in addition to that, we have brought in a new variable, aggregate misreporting, and shown that it is statistically incrementally important. As I said, we do out-of-sample prediction as well. We don't show those results here just for the sake of parsimony and time with what we're trying to get across here. We have significance in the similar quarters like we have that we're showing here. And then we can talk about, well, by how much does out-of-sample recession prediction improve? And I would argue that these are large percentages, from 22.5% to 36.4%, depending on which model that we use. So we would look at this set of results and say these are statistically significant, these are economically significant. We believe that we've added something of value into the prediction of recession and GDP growth, as Matt will talk about in a little bit. Now, one thing that we'll take up in a little bit also in this presentation is, why is this the case? Why is this relation? Remember, we hypothesized a theoretical relation earlier, and we want to follow through with some economic results here shortly.
So this slide shows our real GDP growth results. And what we find here is aggregate M-score incrementally predicts lower real GDP growth at forecast horizons of 3 to 8 quarters ahead. And this is evidenced by the results in this part of Table 5 from our paper. We find a significantly negative coefficient in the K equals 3 quarters ahead through K equals 8 quarters ahead model. So that's in sample. In terms of out of sample, we find that adding M-score to the model significantly reduces prediction error in real GDP growth at forecast horizons K equals 5 through K equals 8. These results are for the two-control model. We also find results for the other benchmark models. The main takeaway here is aggregate misreporting not only has predictive value for future recession, but also for future real GDP growth. So as Ken mentioned, we're trying to get this question of why aggregate M-score predicts recessions 5 to 8 quarters ahead. So our theory suggests that misreporting leads to investment curtailments prior to an economic downturn. And this may be a reason why we observe a lapse in an M-score peak and an onset of a recession of a year or more. And so to get at this, we use a path analysis to assess whether this recession effect of M-score occurs indirectly through this investment effect. This diagram shows the framework that we use to implement our path analysis. Delta 1 is the magnitude of the direct effect of aggregate M-score on recession incidence in 2 years, and we find that that's positive. Alpha 1 times delta 2 is the magnitude of the indirect effects of M-score on recession incidence in 2 years that flows through real investment growth in the next year. And real investment growth, I should note, is a component of real GDP growth. This indirect effect consists of 2 indirect links. And the first link is from M-score to real investment growth in the next year. We find that that's negative. And the second indirect link is from real investment growth in the next year to recession incidence in 2 years. And we also find that that's negative. And then we conduct a statistical test to show that the product of these 2 indirect links is significantly positive. And so our takeaway from this path analysis is that M-score has an effect on 2-year recession incidence, 2-year ahead recession incidence that flows indirectly through lower real investment growth in the next year. And this is consistent with the intuition that underlies our research question. So this may be preempting some Q&A a bit, but a natural question is, so what is your data and what are your models saying about what's happening right now? And so we've extended our data beyond what's in our paper to provide a nowcast for calendar year 2024. And this graphic is showing a time trend plot for two variables. The black trend line is aggregate M-score for an expanded sample over and above what we have in our paper. Those shaded regions, again, are MBR recessionary periods. The blue dashed line is the interest rate spread. We multiplied this by -1, so that has a similar pattern as aggregate M-score. So when that blue dashed line goes above 0, that actually means that there is a yield curve inversion. And when we look at this graph, what it shows is that in 2022 Q4, aggregate M-score peaked and the yield curve inverted. And so flowing those observations through our model, we estimate the following have a probability of greater than 50%. So we estimate that it is more likely than not that the US will experience slower 2-year GDP growth during 2023 through 2024 compared to the trailing 2 years. We also estimate that it's more likely than not that the US will go into recession during calendar year 2024. So these are just estimates from our model. No model is perfect at predicting the US economy, which is quite complex. I know we certainly don't hope for a recession, but time will tell how things play out with the remaining calendar quarters in 2024.
So just a little reflection then on where we are now. We predicted more likely than not that this year we would see slowing GDP growth, and we predicted more likely than not recession. So the upper two figures here are showing first figure showing actual GDP growth, real GDP growth of Q1 2024 to the far right, about 1.3%, which seems quite low. And we can see consistent with what we predicted, the orange bars are getting smaller, dropping. The GDP growth has indeed dropped, certainly through Q1 of 2024. To the right of that then is from the Atlanta Fed GDP now. They estimate a model, and these are estimates that they're making of Q2 for 2024. And if you go to the far right, they've been making these estimates in here, looks like over a few months or so is what we're showing here. If you go to the far right of this, you see those lines dropping, falling, again, consistent with the idea of, at least according to them, lower GDP growth for Q2. Obviously, Q2 is not done yet. We don't know, so that's an estimate. But both of those top figures together are portraying this notion of falling economic growth here in 2024. The third figure, first one on the left and the bottom, that's a Wall Street Journal, bunch of economists predicting probability of recession, doing that over time. The time period here not matching ours, so that just two recessionary periods shown here, but similar notion. And if we went back to our point in time when we made our forecast, these economists, I think, would have been on board with us about this more likely than not. They have dropped, this survey of economists has dropped their probability of recession looking ahead 1 year. Then the last figure that we show is from again, the yield curve, and moving out visually to the far right on this figure, we again are seeing that the yield curve is inverted, and in fact has been inverted, according to Wall Street Journal, for the longest time period in history, and that is at this point not accompanied by a recession. So we have some mixed signals, I guess, with respect to recession prediction. It's very difficult. We hope not to have recession, but it's some unclear signals that we are dealing with in a complex setting.
So that concludes the planned part of the presentation. We'd like to thank the viewers of this webinar. We hope you found it interesting. We'd also like to thank Dean Roger Capallen and the Trulaske College of Business for giving us the opportunity to talk about our research. And we do have some time for a brief Q&A, and so we can open it up for questions. While we're waiting for any questions to come in, and we'll keep monitoring that Q&A. One question that we've been thinking about is whether our evidence extends to a global setting. And so we've done a little bit of preliminary work on this front, and this plot shows the preliminary descriptive data for this analysis. And so what we have here is up to 10 countries in Europe. And for each country, we label a calendar quarter as in recession if it is part of a consecutive 2-quarter period of negative GDP growth. So one limitation with working with a global sample here is that we can't rely on an organization like the NBER to call recessions for us. So we have to use a self-constructed definition of recession. And then for each country quarter, we use firm quarter data, just like we do in the US setting on M-score, and we calculate an aggregate M-score. And then after we aggregate it up to the calendar quarter level, we again construct a 4-quarter moving average. And that is shown in that bold, dark blue line. And the sample begins in 2005 Q2. So the sample is much more restricted than what we have in the US, and that is due to the introduction of quarterly reporting abroad. The orange bars show the number of countries included in the sample. And so that includes 6 to 10 countries. It increases over time because more countries introduce quarterly reporting. The shaded regions, this is a pooled country sample. So to accommodate these shaded regions, we shade them if more than 50% of the countries are in recession. And the takeaway from this plot is that it visually corroborates our US results in that aggregate misreporting peaks before an economic downturn. However, we have much more work to do in terms of pushing these results forward. This is all very preliminary, but stay tuned.
Yeah, see what question rolled in. Any idea what Wall Street Journal economists are considering that your model is not considering? So arguably, I would expect each economist has his or her own model, variables that they think are important. No doubt, I would expect all of them would have yield curve spread, variation of it, and stock returns. Some of them probably go back to a lot of the variables from the Estrella and Michigan paper. So there'd be some idiosyncratic models that would be out there. One other thing to note is that we made our forecast using 2022, end of 2022 Q4 data. We have not updated our forecast. These economists are being surveyed more on an ongoing basis, so they are seeing things that they think might be compelling. So the U.S. economy, I think consumer spending has been good. For example, people are talking about this idea of achieving a soft landing. So there's been some change in sentiment. We're not capturing that because our forecast was made back 2022 Q4 data. So it could be different variables and different models could explain those changes that those economists are coming up with.
Yeah, we don't know what these other economists, they're both from academia and from industry. We don't know what variables are included in the models. To my knowledge, they're not disclosed. I can tell you that the model that we use for our nowcast relies on aggregate M-score and interest rate spread. So if that interest rate spread inverts and we have a peak in M-score, and those are the primary variables included in our model, then our recession probability is going to go up than it otherwise would if we included a whole laundry list of other variables. I'm not saying those models are doing that, but to the extent that they do, then their recession forecasts are going to go down. Good question. I think that's the only question I'm seeing, Ken. You see any others?
That's all I've seen.
All right. Well, if there's no other questions, that concludes our time today, and we'd like to thank you again for attending, and we hope you have a great day. Thank you.
Yep. Thank you all for joining us.